Welcome, everybody. Happy Wednesday to you. Welcome to another session of your weekly Business Live Mastery Wednesdays. Let's go, man. It's good to be with you. Today, I'm actually not in Atlanta. I'm back in North Carolina today, and I'm going to be with you no matter what, guys. On a Wednesday at 10 a.m. Eastern Time, I'm going to be with you. There's no place I'd rather be than to have this conversation with you for a few minutes, just to talk about ways that you can keep your money in your pocket as a business owner. All right, especially if you own a fleet, a trucking company. We're going to be having those conversations every single week. Excuse me. As a matter of fact, I'm looking at other options for this call. All right, so I'm going to be testing out another session. So if you're watching this video live, or if you are watching it after the fact and you want to participate on this call more regularly, this time frame, 10 a.m. Eastern on Wednesdays is what we're doing now. We're going to test out Mondays at 7 p.m. Eastern time. All right, let me know what you guys would like to have as a time frame between the two. All right, because I definitely want to make sure that whoever wants to be on these calls and take advantage of me live while you have me, you have the opportunity to do so. Okay, so that's there. So if you want to have this session on Monday at 7 p.m., you can put a comment in the chat. If you're watching on a recording, if you're watching live, you could do that just below. So we're going to take note of what people say. So the other option is going to be Monday nights, 7 p.m. Eastern time. Or we're going to continue to do this at 10 a.m. on Wednesday mornings Eastern time. All right, guys. So let's get to it. If you didn't know, now you know. This is me, Cheston Bulgen. I'm a senior consultant over here, founder and CFO at By the Books Consulting. This is how you reach us, 888-4BTB now, or 888-428-2669. All right. You can also reach us on the web at bythebooksconsultants.com or at youraccountingsuperhero.com. And we help businesses out, especially if you're in the trucking industry. We have a real good understanding of how that market, that industry works, and we're able to serve at a high capacity in the trucking industry, notwithstanding that we do help out other industries as well. Okay. So we do accounting, tax strategy, tax planning, and business consulting and fleet advisory for trucking companies. All right. So if you want to take advantage of those type of services, we are your partner in those areas. You can reach out by any of these means. Quick disclaimer before we get started: the following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. So let's go, people. In the beginning, we talk about the pillars that we stand on. All right. So we're just going to go through these pretty quickly. And hopefully we can get out of here within the next 15 minutes or less. All right. Not to bog you down with too much technicalities inside of what we're talking about today, but I want to give you a general overview of what it is that you can take advantage of in terms of deductions today. So we're going to go over this real quick and we're going to get into it, and then we're going to get out of here. All right. So the four pillars that we actually use in the foundation of what we are in this community, in this conversation, are: number one, intentionality, which is mindset mastery; number two, financial mastery, which is also known as financial literacy; number three, structures, which is also system mastery; number four, actions, which is also called execution mastery. Now, here's the thing: if we have all of these working together in harmony, then your business is humming. You're actually achieving the results you want to achieve. You can take it to whatever level you want to take it to. You're most likely having tremendous success if all these components are put together. Okay. Now, if you're not having success, which means you're not really getting the results that you say that you want inside of your business, and most likely it's in one of these areas that we need to put back into alignment. All right. So intentionality, where is it that I'm focusing my attention? That's basically what that is. I have mastery over those things in my mind. Number two, financial literacy. If you're knowing that number story, understanding what the numbers mean, being able to use that to make sound decisions and choices inside of our business and in our life. And number three, structures, how we solidify the systems in our business. We do the actions. We make sure those actions are locked in with a structure to make sure we don't have to keep repeating things or doing things over and over again. And then actions, execution mastery is like, okay, when the rubber meets the road, am I actually taking actions in line with what I say that I'm creating out here and creating that result? All right. So that's that. If you ever want to have more detailed illustration of what these are specifically, you can watch some of our older videos inside of our YouTube channel. They're there. All right, guys, let's go. Today we're talking about maximizing deductions for truck fleet owners. Man, such an exciting topic, man. I tell you what, there's so many ways that we can keep money when we run our businesses. And today I'm just going to go over a couple of things with you to show you how you can take advantage, maybe look at some strategies strategically, how you can execute on keeping more of your money in terms of deductions in your company. Now, there are a couple of things here that we look at when we're talking about maximizing deductions today. The two things that we want to talk about right now, there are more, but there are two things specifically I want to leave you with today. All right. The two things, number one is Section 179. All right. That's a depreciation. All right. So it's what we call depreciation deduction. We're going to talk a little bit about that. All right. To get clear on what that may be. And, and number two, we're going to talk about retirement. Okay. So let's get into that conversation. I'm going to be here with you real quick and talk about Section 179 and what that is. Okay. Now, some of you may be familiar with the terminology, Section 179. Oh, yeah, if I have a vehicle that's over 6,000 pounds, I can deduct that expense for that vehicle. Excuse me. I can deduct that expense for that vehicle and reap the benefits of, not really outlaying so much cash. I can keep my cash, but take that deduction. Okay. Now, there are some things that we want to take into consideration. There are a lot of other things that we could write off in Section 179 than just the vehicle. Okay. Now, if you're a trucking company, you're in the transportation industry. So there are certain things that we get access to in terms of write-offs in Section 179 that others don't. Okay. Like, for example, a lot of people talk about this 6,000 pound vehicle, right? Really, in the most current write-off in 2023 is, I believe, 28,900 is the maximum that you can take as a deduction for vehicles, passenger vehicles that are greater than 6,000 pounds and less than 14,000 pounds. So that's different. That's unique. Okay. If you're a business owner outside the trucking industry and you have a passenger vehicle which is ordinary and necessary for the operation of your business, like an SUV or something that's greater than 6,000 pounds, but less than 14,000, well, this applies to you. Definitely, absolutely, 100%. But if you're in the trucking industry, all right, there are so many ways to leverage this write-off. And the reason I love depreciation, like Section 179, especially for the trucking industry, is that, this is an asset-based company that we run here, right? When we're talking about an asset-based company, it means that you're purchasing equipment, you're purchasing trucks, you're purchasing things that cost thousands of dollars, tens of thousands, hundreds of thousands of dollars that you will need in order to operate the business, right? And the more that you accumulate these things in your business, right, these assets in your business, the more profitable, the more successful, the more money you can make in your business. If you're in a trucking company. Why? Because we need those assets to generate a return on the asset, right? We call that ROA, return on assets, which means that if I get a truck and a trailer and I spend money on this thing, I spend $50,000 on it, and I go out and generate $150,000 to $250,000 on that, then I'm getting a major return on that asset that I purchased, which is like fantastic, right? So imagine that. Like if I get 250,000, that's 5 times what I spent on invested in on the vehicle that I got returned. Now I might not be able to keep all that money. So if I take that gross amount that I made off of that truck, off of that piece of equipment, off that asset, and I look at the end of the day, well, how much did I really make? If I netted 100,000 out of that 250,000, then I'm saying I made a 100% return on my investment. I actually doubled what I put into this in the first year, right? So that's the reason that I really love, this particular strategy, right, for the trucking industry, because we are asset heavy, right? And we need assets in order to make the returns. We can really print money if we wanted to inside this industry. Okay, as long as we run the operation efficiently, we can print money. And now we can optimize it by keeping more of that money right? And keep more of that net profit, because we don't necessarily need our own cash to invest in these pieces of equipment, but we can deduct it in the first year, right? Using Section 179. You don't have to deduct everything in the first year using the Section 179 either. You can use it how you see fit. Maybe you want to take more of a write-off this year or more of a write-off next year. You can actually strategically plan on how you want to deduct the expense of your equipment over time, right? So just let me backtrack real quick. So depreciation. I want to break this down in a way where it's like layman terms for depreciation. So some of us understand what it is, some of us don't. Okay. Now, when we're talking about depreciation, it's an expense that we get to take for our business, right? But it's like really, we're getting limited to how much of an expense we can take for major purchases. When I say major purchases, anything that's over $2,500 that we purchase something, like purchase a piece of equipment or asset for, if it's more than $2,500, the IRS says, well, hey, we don't want you, we don't allow you to take that full expense in the first year, right? We want you to take that expense over the life of that item that you purchased or that asset that you purchased. So for example, if the item has a useful life of 5 years, the IRS says we want to make sure that you take 1/5 of that value of that asset each year as an expense, because that, we want to make sure you expense that over the life of the vehicle, or life of the asset rather, right? So those are the rules. To expense over the lifetime of the asset, you cannot take it up front. That's like standard depreciation rules, right? Now, but there are other things, right? This is where people are like, man, what? This gets complicated. It's like, well, what do you mean? You said the rule is I have to take it over time. Yeah, you do. Typically you have to take the expense over time. If it's more than $2,500, you have to take it over 5 years or more. If it's a 5-year piece of equipment, or if it's a 7-year piece of furniture, or if it's a 15-year intangible asset, like that we need to amortize over that period of time. Well, yeah, typically that's what we do. But we have these special rules that you can use in case you want to. One of those special rules is Section 179. It means that I can take more of the expense of that particular asset up front in the first year. Okay, I can actually write off the whole thing if I wanted to in the first year, as long as it's not over the maximum limit that they are allowed for that specific ruling, right? So if I have this at my fingertips, a tool to use at my fingertips, well, I want to understand, well, how am I going to use it for what I do? Now, if you're in the trucking industry, this is a really great tool to use to plan out, well, how you get to keep your money. Because if I go out and I'm purchasing assets for my fleet, and I go out and finance a lot of these assets for my fleet, which means I don't really take money out of my own pocket so much. It might be a portion, maybe a down payment, but I go out and strategically use financing to purchase this asset. I can still write it off. Say what? Yeah, I can still write it off. I can still write off that asset, even though I did not take my own money and purchase it, which is great. It's like cash flow strategy to perfection right there, right? I get to keep more of my money in my pocket. Not only do I get to leverage somebody else's money, but I also get to reduce my overall net income without having to really expense anything significantly to reduce that overall income, right? So most of the time throughout the year, this is what we want to do, okay? We want to take a look at where we stand profitability-wise. How are we performing? Like, so if I'm looking at my profit and loss consistently and reliably throughout the year, like I'm taking a look at, well, how much did I make all total overall? How much of money did I generate for this fleet? Okay, out of all of that, well, how much profit am I expecting to make right now? Oh, it looks like I'm going to make a lot of money. Well, maybe I can invest in some other equipment now to expand my fleet and grow without having to do an outlay of cash on my own. I can do financing, get somebody to borrow money from, right, to finance that equipment. And then I can write that thing off this year, right? showing a loss, but really I get to keep my money because I'm not paying Uncle Sam, for the profit that I would have made if I did not write it off. Okay. So to bring it back home, and just in case you didn't know, like if we have income, right, and then we have things that we write off, we call these deductions, right? I'm lowering the amount of taxable income that I have. Right? I was in a conversation yesterday with a group of business owners, and we were going over, well, what does it mean to have a deduction? What does it mean to have a write-off? So I want to make sure in this conversation we make it plain that a write-off and or deduction, right, is something that we spend money on that directly impacts the amount of money that we make at the end of the day. So if I have an amount of money that I make, but it costs me this much in terms of materials, supplies, office expenses, travel, advertising, wages, um, permits, licenses, all those things, all those line items are deducted from my overall income. So it produces me a net income at the bottom after all is said and done. Now, if I can reduce that net income and still keep money in my pocket, then I win. All right. So I'm looking at all these strategies to actually create it in a way where I can actually increase my cash flow, but reduce my net income, in ways that work for me all the way around. And when I say all the way around, well, if I go for financing and I go for loans, depreciation, the thing that we're talking about here, this section 179 deduction and depreciation, is something that lenders really won't consider as a real expense, right? So I win because if I go to get a loan as a business owner, as an entrepreneur, as a fleet owner, and I give them, my tax return, it might show that I did not make a whole lot of money because I had all these asset purchases this year that I wrote off section 179. So it might show a loss or might show very little profit. It makes it seem as though you don't have a whole lot of money that you're bringing in. But guess what? If we see that the line item that's really impacting your bottom line is depreciation, well, lenders, they don't really consider that to be a real cash flow impacting line item. They'll add that back to your finances. In most cases, they will do that. All lenders will do that. Okay. So now if you're actually setting yourself up to get financing for things in your life, like you're purchasing a home or you're going out for some other type of credit, you can actually take this financial statement as is and understand that they're going to back out that depreciation expense to bolster up your income. And now this is standard across the board. It's something that is real. It's legitimate that they do. They put that income back on for financing, right? But the income comes off for taxes, right? So this is one of the main reasons. Now, to complete on that before I move on, this will deliver, you actually winning inside of your finances when it comes to getting loans and winning when it comes to taxes because you're reducing your overall taxable income by this deduction, right? So it's a win in all these areas, right? Now, this is one of the main reasons why I love depreciation strategies in trucking and any asset intensive business, right? Because now you have a way to shelter yourself from being overly exposed to income taxes each and every year if you use this right? And you're not really impacting your financial positioning when it comes to getting financing or doing the things that you want to do outside of your business, right? So this is very key, all right? This really, really powerful strategy, all right? Now, that's section 179, deduction, all right? There's so many other ways to take depreciation inside of our business. And I want to highlight this particular one for the trucking industry because it's very powerful in terms of the flexibility that you have to take how much depreciation that you want in the first year, and then take the rest in all other years if you see fit to just take a portion and then move it on to the next year to take a little bit less, maybe in a future year. It has tremendous flexibility, and it allows you to really plan out exactly how you want to keep your money throughout the year. If we're watching things and monitoring things all through the year and asking these questions. Hopefully that makes sense, guys. All right, so that's that for section 179. The other thing that I want to talk about is retirement. Retirement's another great strategy, okay? Because the idea is, how do I keep my money? One of the great things and the great incentives, rather, that the IRS has is for you to save for retirement, okay? So any type of strategy you use as a business owner to make sure you ensure the retirement of yourself and the retirement of others well, then you're going to win when it comes to being able to keep your money, right? You might not have direct access to that money now, right? With, you know, by rule, because you want to use that money in retirement. But this is a great way for you to actually set up your retirement and keep your money today in terms of not having to pay extra in taxes. All right. So one of the biggest things is to have a qualified retirement plan as a business owner. There are a few different options that we have. You have your SEP IRAs, you have the solo 401ks, you have traditional 401ks, right? We have Roth options for retirement. So there's so many different versions of retirement that we can use to strategize and keep money in the future for retirement and save taxes now. Okay. Now, one of the main things, like the traditional plans, right? The traditional and retirement plans, qualified plans, allow you to deduct that contribution that you give to retirement from your overall income, right? So basically, you're reducing what we call your federal income tax by moving that money, pre-tax dollars, right? Pre-tax dollars into a qualified traditional plan, right? So what does that look like as a fleet owner? Well, as a fleet owner, you might want to have, a traditional IRA or a traditional 401k to which you contribute to, and your company matches it. So your company matches your contribution, and if you have other employees, you have a matching contribution to them as well. But here's the thing, right? The money that you take off, take off of your actual net pay and put it into retirement comes off of your income tax wise. So now you're actually not paying federal income tax, right? Federal withholdings, federal income tax on the amount that you put in retirement. You pay that at a later date when you take your distributions from your retirement or withdraw from retirement, right? But now you get to keep that money, that tax money in your pocket. Now, the reason I'm bringing this up, retirement strategy, because inside of trucking, a lot of the times we'll set a trucking company up as an S corp, right? Especially if they're making a good amount of money, if they're set up as an S corp, and there's that reasonable wage portion of their S corp that they want to be compliant with. So what if we were to take that reasonable wage compliantly, right, which reduces your self-employment tax? Wow, fantastic. Reduce self-employment tax. But then we maximize your retirement, right? So then you're going to actually reduce the federal income tax on the amount that you're paying yourself as well, right? So it's like you can reduce FICA, which is self-employment tax, and you can reduce your federal income tax, double whammy, right? So those are the things that we have access to in terms of two real good strategies to use for yourself as a fleet owner to keep more money in your pocket. Now, I'm not going to take the time today to get into the examples of what this will look like, but it'd be really good to get into that, right, guys? So maybe next time I'll get into some numbers. We can actually see them out here on the screen in terms of what that impact would be if I were to use a Section 179 deduction, if I were to contribute to a retirement plan, and what that looks like for you and how much you can actually save. Now, check this out. When you save this money and you put it into retirement at an interest-bearing account, well, you're actually accumulating money. You're actually making money, and you are saving money in taxes right now, and it is like a win-win scenario. The only downside that I would say about the retirement strategy is that we don't know what the future tax rates are going to be when you actually go to retire, start to withdraw from retirement. So you will pay taxes on the money eventually on these plans that you don't have to pay income tax on upfront. It's deferred until when you withdraw from retirement. But in addition to that, we can take after-tax dollars and put it in another account, a Roth account, right? And we'll talk about that down the line too, to make sure you have all those other strategies in place so that you don't have to pay taxes later on. Pay them today, but don't have to pay taxes on any of the gains that you make in retirement. And when you withdraw, you don't have to pay any taxes, so you can make money tax-free. We call it having a tax-free retirement strategy, okay? All right, guys. This conversation has been great to be in with you. I know that, I get a twinkle in my eye when I talk about tax and deductions and strategies, but not everybody gets a twinkle in their eye like me. All right. But I'm glad you're in the conversation with me. I'm looking forward to having the conversation with you next week. Now, in the beginning, I said that we're looking at a different option to have this live stream happen on a Monday at 7 p.m. Eastern time rather than have it Wednesday at 10 a.m. Eastern time. So put your feedback into the chat. Put your feedback down below the video if you're watching from YouTube. Let me know what your preference is. It's either going to be Monday at 7 p.m. Eastern or continue to do this at Wednesday at 10 a.m. Eastern time. It's always a pleasure to be with you. It's always great to be with you. I will talk to you next week. Have a great day. Have a great week. Until then, take care, guys.